Hello, and welcome to the third of our Capital Economics property webinars. Today our theme is the future of property. My name is Andrew Burrell, and I'm Capital Economics Chief Property Economist, and with me are Kiran Raichura, our Senior US Commercial Property Economist, Matthew Poynton, our US Housing Economist, and Amy Wood, European Commercial Property Economist. Early on in the pandemic, it became clear that there would be major changes to property after the crisis. Over the last 6 months or so, we have produced a series of in-depth papers that have identified the main sectoral issues for the next decade in property under the banner of Future of Property. Today, we will provide a summary of this work covering how remote working will shape office markets, what this means for residential property, the impact of COVID on retail and industrial markets, and then finally we'll finish with some thoughts about how these trends interact and impact on cities. Before we start, please note the panels on your screen which feature the relevant research material. This includes the papers, the focus papers, in which we present much of the material that we're going to cover today. And there is also a link to our Future of Property landing page, which includes further research on this theme. You can also download a copy of the presentation slides, and in addition, there is a link at the bottom of the screen for more information about our services. Our slideshow will take about 25 minutes and will be followed by up to 10 minutes of Q&A. So please make use of the available box on your screen to ask any questions you have. We'll try and answer as many of these as possible during the session, and any that we don't, we'll reply by email over the coming days. So without further delay, I'd like to move on to Kiran. There's clearly been a radical break in terms of the remote working during the pandemic. So how will this affect offices in future?
Thanks, Andrew. So first, I think it's important to note that our analysis is based on a post-COVID world. So in our calculations, we assume no explicit need for social distancing in the workplace. And instead, it's behavior change that was triggered by the pandemic, but which persists into the future that shapes our views. And then the result is that offices will be the sector that are most changed by the pandemic. So household survey data from all three major regions that we cover, the US, UK and Europe, shows that remote working was relatively limited in most countries prior to the pandemic. Of course, there are jobs for which home working isn't possible, but even in the office sector, up to 2019, the share of home working was relatively low. This chart shows a time series for the US, and while there had been growth in the remote working over the last 2 decades, the total share of office workers working remotely, some or all of the time, is likely to have been between 20 and 25% in 2019. Data from the UK and major Eurozone countries suggests levels that are broadly in line with this. But the pandemic has proven that the vast majority of office jobs can successfully incorporate at least some degree of remote working. The negative perception of remote working by many business leaders has been eroded, having seen productivity hold up well. And the pandemic forced many firms to set up the requisite infrastructure to support remote work. So those two factors support a major structural change. While what we saw in 2020 in terms of the share of remote work is unlikely to be a permanent change, we think that in the medium to long term, we could see more than half of office workers spending at least 1 day a week at home. Within that figure, we expect the majority, around 30%, to be mixed, so spending time at home and in the office, although 20 to 25% could still be at home full time, as you can see in the chart. So what does this mean for office demand? Let's consider how firms might reduce their space in response. In our framework, we've assumed no space needed for those working fully at home, and a reduction in space of 20% per worker for those working at home at least once a week. i.e. for every 100 mixed workers, there'd be 80 desk spaces in a given office. So this chart shows the amount of occupied space in the US over time. That's the black line, and that's actual data plus forecasts, and our estimates of required space over time in the blue. And you can see a sharp drop in required space last year as the majority of workers were mostly at home. Occupied space, though, drops more gradually in our forecast than in previous downturns, because in this case it's not caused by firms going bust, as much of the tick downs would have been in 2001 and 2008 to 9. This time, firms will need to wait to exercise lease breaks and will need to sublet to reduce costs. So by the end of the decade, the total fall is a 6 to 7% drop in occupied space. And our modelling suggests a similar outcome in our European markets as well. Now, that 6 to 7% fall seems below that suggested by some surveys we've seen, which seem to put the figure at 10 to 15%. We think that this reflects the effect of incorporating employment growth. That's particularly significant in the US, where we see employment ending the decade about 10% higher than it was in 2019. Without that jobs growth, clearly then the reduction in space would be more like 15%. And job growth is actually far less of a help in the Eurozone, as we expect an increase of only 4% in employment. So what else matters when considering the effect this will have on vacancy and rents? Well, to make matters worse, there will of course be additions to supply in the next few years. Even though we expect some projects to be delayed and others to be cancelled entirely, we expect office stock or inventory to keep growing in the next 5 years. This means that in the US, for example, vacancy will keep rising through the next 5 years. And only when we start to see conversions to other uses from around the middle of the decade, as some stock becomes obsolete, will vacancy begin to edge back lower. This chart shows those changes in vacancy for the US. They're in blue and inverted, so a rise in vacancy would be towards the bottom of the chart. For a market close to equilibrium, changes in vacancy tend to correlate well with changes in rents. So this points to US office asking rents falling throughout the next 4 to 5 years. The same is true in European markets. Some will make this drop in rents back up in the second half of the decade. For the US, for example, though, while rents would finally exceed their 2019 levels in 2030, vacancy would still be 4 percentage points higher, meaning that the income level in an average portfolio would still be below where it was in 2019. There are two additional points to consider. First is that our structured step-by-step analysis allows us to test different assumptions. So this chart shows the set of potential outcomes for the change in space and the impact on vacancy rate for different levels of working from home. It has held constant our assumptions for employment growth, fully home-based workers, how much firms would reduce space per worker by, and the total change in stock by 2030. You can see that in our base case, vacancy is 4% higher, as previously mentioned, but that figure rises to over 7% if another 13% of jobs become mixed. At the other end of the spectrum, if you don't believe that remote working will be at these levels in the long term, you can achieve outcomes that look much nicer for office landlords on the left of the chart. Of course, there are lots of moving parts, so in the interest of time and clarity, I've simply looked at one here, although clients can see more in our scenarios for US offices update on the Future of Property homepage. As I've mentioned, we've also done similar work on our European and UK commercial property services, which this chart shows some of the results of. Differences in markets are in part driven by the expected share of remote working in different countries and also in different sectors. But there are also major differences in terms of the effect on vacancy that are caused by the size of the development pipelines and the outlook for employment growth. Berlin is the worst hit in our analysis, largely due to its substantial pipeline, that is due to be built in the next few years. So that concludes the whistle-stop tour through our office sector analysis. And so to sum up, the pandemic has caused a structural change in where office workers work. More than 50% will now spend at least a day a week at home. This will hit office demand, which could be 6 to 7% lower by 2030. New supply in the first half of the decade will also add to the impact on vacancy before conversions and weaker development reduce the stock from 2025 onwards. Nevertheless, vacancy will still be elevated in 2030, with most markets in the range of 2 to 6 percentage points higher. And as a result of all of this, rents will fall throughout the next 4 to 5 years and may only just return to 2019 levels by 2030. Handing back to you, Andrew.
Sorry, thanks, Kieran. And we're going to move on now to Matt, who's going to be covering residential property. Offices have clearly been disrupted from what we've seen by the move to remote working. But how will this affect where people live now that office location is becoming a less important feature?
Thanks, Andrew. Yeah, so as Kieran has set out, we expect a permanent shift toward working from home, with a new normal of perhaps half of all office workers working from home at least some of the time. Outside of offices, the impact will clearly be a lot smaller. The opportunity to work from home limited in other sectors such as manufacturing and hospitality. So that will limit the size of the impact of the shift to home working on the overall housing market. Most of the impact will be on the 20 to 25% of workers who are office-based across the US, UK, and the rest of Europe. Now, for some without an office to go to, that will provide an opportunity to move away from expensive city centre locations toward cheaper suburbs and perhaps smaller regional cities. And there is certainly evidence that there has been a move away from cities in the US. Home sales have boomed as some households have left cities and bought homes elsewhere, and rental vacancy rates have seen the largest rise in big cities. All that said, we don't think this spells the end of cities. They are attractive for a whole host of reasons beyond their proximity to work, for example, entertainment and culture. And for those working part-time in the office, proximity to the workplace will still be valued. It's also important to note the role of demographics behind recent moves. In the US, there is currently a bulge of people in their late 20s and early 30s, the millennials, shown here. And that is an age when households tend to move out of cities for family reasons, or because the lure of city living is no longer quite as great as it once was. And we have seen that internal migration was negative in many large US cities, even prior to the pandemic, with the exception of some in the South, as these demographics play out. So once these households have made their move, we expect the demand for suburban living will start to normalize. So no big permanent shift away from cities. However, we do expect to see a more permanent shift in the type of home demanded. Given our expectations that more people now work from home at least some of the time, households will demand more space and higher quality amenities. That is likely to mean a reversal of recent trends in apartment size in the US, which have been getting smaller. As this chart shows, the share of apartments with 2 or more bedrooms has been trending down since the mid-2000s to only 50% by 2019. For those who stay in cities, there will be a need for larger units. In the short term, the drop in city populations will allow for some households to find larger units. Beyond that, as populations stabilize, we think there will be a boost of supply as empty offices and retail space is converted. As Kieran has just set out, demand for US office space is set to drop back markedly, thanks to increased working from home. Now, it will take time to convert empty offices to apartments or knock them down and rebuild, but we expect the share of new apartments in the US with 2 or more bedrooms will return to between 65 and 70% over the next 5 to 10 years. However, while households will demand larger apartments, we don't think they'll have much more money to pay for them. Years of relatively subdued income growth has pushed rents as a share of earnings in the US to a record high, as this chart shows. Now, there may be some savings from reduced commuting costs, but it's hard to see where more money for rent will come from. Instead, we expect rents will grow roughly in line with earnings. And given larger unit sizes, that implies a small fall in rent per square foot. We also expect yields will hold close to their current level, and that implies that capital values will therefore take a hit. That is in line with our view that we're going to get a boost to apartment supply from converted offices. Overall, in the US, after a slight recovery in values following the direct impact of the virus, we expect capital value growth will average just over minus 0.3% from 2025 to 2029. In the UK, the institutional build-to-rent sector is much smaller and has only really got going over the past few years. But similar arguments apply. Units will need to be larger, but with rental growth limited by affordability, capital growth will take a hit. The resulting weakness in capital value growth may act as a disincentive to some developers, slowing the build-to-rent sector. As set against that, empty offices mean land will be cheaper, and we also expect yields to hold up relatively well against risk-free rates. That may increase attractiveness for those looking for long-term income rather than capital gains, and those tend to be institutions. In fact, that may crowd out amateur investors who tend to value short to medium-term capital gains, leading to increasing professionalisation of rental units in the UK. Turning quickly to house prices, a similar argument applies. While households will want to spend more on a house now that they're spending more time in it, the already high level of values, the fact mortgage rates won't fall any further, and new regulations on mortgage lending rule out another house price boom. In the US, after initial boost from pent-up demand and record low mortgage rates, we expect house price growth will then slow. After all, the boost to affordability from lower mortgage rates has already been largely wiped out by higher house prices. Longer term, we expect house prices will rise roughly in line with earnings growth. In the UK, the introduction of the stamp duty holiday means that we're in for a bit more of a turbulent ride. The boost to values the cut has given will be reversed this year, leading to house price falls. But after that, the same dynamic of low but not falling interest rates will constrain house price growth to earnings growth. This table summarizes our house price and rent forecasts for the UK and US. House price growth is slightly higher in the US in the short term, as there's been no disruption from fiscal policy. Longer term, slightly higher earnings growth in the US leads to slightly higher house price gains. In the rental market, rising vacancy rates and a weaker labour market mean rental growth has slowed in both the UK and US in the short term. Longer term, the move to larger apartments will weigh on rental growth, particularly in the US. The small impact in the UK shown here reflects the less developed institutional sector, which means a less pronounced shift to larger units. So quickly summarising the residential sector, working from home will shift demand from space from commercial to residential. But after initial boost due to demographic factors, we think the move to suburbs will largely subside. Most jobs will stay tied to workplaces and cities will remain attractive. While households will demand larger spaces, any rise in house prices or rents will be constrained by affordability and also some supply response. Increased demand for space will boost apartment size, and that implies lower capital and rental value growth.
Thanks, Matt. At this point, we're going to shift our focus somewhat to look at consumer behavior, and most notably the acceleration in online purchases. Move on to Amy, who will cover what elevated online spending could mean for retail and industrial property.
Great, thanks Andrew. So the key development from the pandemic, which we expect will have lasting impacts on the retail and industrial property markets, is the boost to online spending. As you can see here, the share of online retail sales in the UK reached over 30% last year, from around 20% in 2019. And in the US, the increase has also been substantial. We think that online shares are unlikely to stay at these elevated levels, but we do think the pandemic will lead to a faster online transition. The reasons for this are twofold. First, we expect the pandemic to bring forward a couple of years of online spending. This seems likely as much of the increase in online demand has been in categories where the share of online spending was previously low. Examples of food, health, and beauty. And this has been the case even though the stores selling these items have generally not been forced to close. Second, and probably more importantly, we think that changes in the way we work and live will allow online shares to reach a higher level in the longer term. As Kieran's discussed, we think more people will work from home. This makes online delivery more convenient and also more necessary if workers travel less to city centres and their shops. This impact would be larger still if even a small number of people move away from urban centres. We think the markets which are most likely to see this faster online transition are those which start from a higher base for online spending. The most obvious is the UK. As you can see here, we think that online shares in the UK could now reach 35% in the longer term, compared to our pre-virus expectations of 30%. There are also other markets in Europe with online shares similar to the UK, and these also look more open to a post-virus acceleration in online growth. Examples are those in Benelux, Germany, and the Nordics. To assess what all this means for retail property, we also need to consider the outlook for consumer demand. In the UK, this faster online transition is expected to coincide with a period of weakness in consumer demand. As the left-hand side of this chart shows, this points to a pretty muted outlook for offline sales growth, which is what matters for physical property. On the right-hand side of the chart is the comparison with the US. Here we think the outlook for consumer demand is better. And because the starting point for online spending in the US is lower, this means offline sales growth is expected to be stronger than in the UK in the coming years. But even this will be a slowdown compared to the previous decade. All that said, the outlook for retail was already downbeat before COVID-19. Retailers have been adapting to the challenge of online spending for many years, and issues of oversupply have been ongoing in the likes of the US and the UK. So, although this weaker outlook for in-store demand will add to the problems facing the sector, it doesn't change the bigger picture that retail fortunes will remain poor. Because of this, in our view, the lasting impact of COVID-19 on retail will be relatively less severe than on offices. Although a faster online transition is retail's loss, it will be industrial's gain. And we've done some work to quantify how big this impact could be. To do so, we've combined our macroeconomic forecasts for online and offline retail sales with estimates from Prologis and property agents about how much additional space is needed for each additional dollar of online and offline spending. Our results suggest that the faster online transition could boost industrial demand by an additional 15% in the UK and the US over the next decade. But the bigger picture is illustrated in this chart. It has our estimates for acquired industrial space in the UK plotted on the left-hand axis, and those for the US on the right-hand axis. As you can see, although we expect the same additional boost, we think US industrial demand will increase by more when compared with the previous decade as online shares catch up. That said, a key takeaway from our work was that in most markets, it seems unlikely higher demand will lead to a permanent increase in rental growth. This is because there's little evidence that higher online spending alone has led to a structural change in the pace of rental growth in recent years. In the UK, for example, we instead think that supply shortages were the key reason why industrial rental growth detached from the underlying strength of the economy in the mid-2010s. But the supply backdrop is now less constrained in the UK. In the US, supply capacity is even greater. And although stock per capita is low in Europe, the ability to service demand through cross-border deliveries means supply potential is higher. Therefore, we think any initial boost to industrial rents as online shares rise will prove temporary. This chart summarizes what this all means for rental growth in the coming years. Across countries, industrial rental growth is expected to outperform at around 2% per year. Meanwhile, the outlook for retail rental growth is muted. This is particularly the case in the UK, where we don't expect to see a return to rental growth for at least the next 5 years. Back to you, Andrew.
Thanks, Amy. So really, what we need to do now is summarize what you've heard so far. I push the slide to the audience. And also, I'm going to cover a little bit about what this could mean for cities at the end of the presentation. One thing to note here is that if people do have questions, please keep them coming, as we will still run the Q&A at the end of the presentations. So then, moving on to the main takeaways from what you've heard from the sector analysis, home working is clearly a key trend post-COVID. For offices, which are most directly affected, it will be a big hit, reducing demand despite rising service sector employment and squeezing investor incomes long term. It will also influence residential property. But as the pull of the cities is reasserted, this should stall the exodus of urban residents after the virus is gone. In addition, a plentiful supply of obsolete retail and office space will create opportunities for new urban apartments, though bigger units and affordability constraints may limit investment performance over the longer term. In contrast, the impact of COVID on retail and industrial property is more of a nudge to pre-existing trends. There are certainly impacts, as Amy has outlined, but the analysis does not really change our initial view, and in particular, it doesn't change the ranking of the sectors, with retail remaining the weakest and industrial the strongest, really across most of our markets going forward. A quick point on other sectors which we haven't covered today, and the reason for that is that we think the damage there is more cyclical than structural, although in some cases it's quite severe. We expect, for instance, that hotels and leisure property should recover once the economic conditions improve, and indeed, extra force saving in the pandemic may even give these sectors a boost in the early years of the recovery. So if we move on to look at the city analysis, now obviously property is highly clustered in cities, and the trends that we've outlined are very much sectoral trends, but how they interact is very important to how cities will develop over time. We think from the start that, some of the initial scaremongering that we heard about the death of cities, and cities, it should be noted, have been very resilient over a long period of history. That scaremongering was certainly overstated, but our work does imply that there will be changes going forward. For real estate, the biggest challenge will be the amount of obsolete commercial space, particularly office and retail space, that it's likely to create. As Matt touched upon, conversions to living uses, primarily apartments, but also other types of accommodation, will certainly help to fill this gap. And this too will be aided by downward pressure on prices and solid demographic drivers for these sectors. Though, as we noted in our analysis, there may be some caveats about long-term investment performance. There's also a role, we feel, for urban logistics, with online penetration accelerating during the pandemic and expected to remain high. Here we feel that urban logistics is possibly a different type of substitute for obsolete commercial space than apartments, given that it's generally located at the edge of the cities rather than in the middle. But the demand for this is likely to be very strong, and we do expect it to play a role in the regeneration of cities going forward. One final growth area is hospitality. Sectors related here are driven by consumer demand, which is expected to hold up over the coming years in most markets. And we would expect demand for bars, restaurants, and hotels, which is obviously affected heavily by the lockdowns, to thrive again after COVID disappears. this table really summarizes some of the subsector conclusions we made from this analysis. And from this, we've kind of thought a bit about what might happen to cities, some of that interaction of trends that I mentioned earlier. In this, I've just got a few things to mention. I think the first dimension that I would mention is the larger cities, what are called gateways. And we think they're more likely to be well placed to continue to operate in the way that they always have. Now, it's true that they do have a lot of office and retail space, so they will have to adapt, as all urban locations will. But they also have a wider attraction for living, working, and visiting. So they're also strong in other sectors as well. And we think they may avoid some of the worst consolidation that we expect in smaller cities. Elsewhere, there will clearly be more challenges. And because of this, we think that there may be a new role to emerge in terms of how medium-sized cities could change going forward. In this, you would have more livable, as we call it, more livable towns based less on the traditional commercial uses of property and having more leisure and living. The idea here would be these would provide more of a draw by being good places to live. They would provide more of a draw for workers who will now be more mobile because of remote working and less tied to the bigger cities. For other locations, of course, there will still be concerns. Given the size of the changes, some may require regeneration, as the conversion of commercial space may not be possible or viable. And we would expect to see more community and social use to emerge there to prevent a sort of urban decay. Though the other thing to mention there is that some of these cities were probably already struggling before COVID. So then, whatever happens, I would say, we will continue to monitor it and cover it in our regular property releases. So at this point, having gone through all the main presentation material, I'd like to pause and do the Q&A session. As I said before, roughly 10 minutes of questions. We'll try and cover as much as we can here. But I'd like to start with Kieran. And perhaps, Kieran, you could comment. We've had a couple of questions in about space per worker and trends in space per worker. Maybe you can comment on how that fits into your analysis of office markets.
Yeah, sure. So this is something we looked at quite a lot in the early phase of the work we've done on the office sector. I think one thing to mention first off would be that it's true to say there appears to have been a large fall in space per worker in the last decade or so in particular. So the chart for the US looks like that has accelerated in that last 10 or 15 years. And when we kind of thought about it a bit more, we recognized that some of that, or maybe a large proportion of that, is actually down to an increase in hot desking and some of the kind of stuff we've actually been talking about, where firms actually have essentially less desks than people, which changes those numbers. So that's just worth being aware of in terms of how we think about this. It's definitely true to say, though, that there has been a gradual reduction in space per worker across the board. I mean, if you think about the European markets, then those that have historically had very high levels of space per worker have seen pretty decent reductions in the last 10 to 15 years. Essentially, those with more gains to be had have seen the biggest change. I think it's definitely fair to say. But even in places like Paris and London, there's still been a gradual kind of trickle down of those numbers. In terms of what that looks like going forward, so for the kind of reasons I stated about the last 10 to 15 years, it appearing to fall because of a more intense use of space because of hot desking, essentially. If you think about what we've said in terms of 20% less space for those people working at home, partly that's essentially a continuation of that trend or an acceleration in it in some markets. So that's an element that we definitely think would continue or kind of grow stronger. But in terms of the actual explicit physical space per person when they're in the office, I think it's a good question. I think it's fair to say that there are potential reasons why you might allocate more space to workers. For a start, if offices are going to be the place where people go because they need to be there or because there's a real kind of like collaborative work to do, then the logic follows that there should be more meeting space, more breakout space, more space for kind of casual connections, maybe even more kind of space to do quiet work, because if there's more kind of collaborative space, then you kind of almost need the opposite of that at times as well. So that's a partial offset to what we're saying in terms of reduction in space per person, but that's also all kind of factored into the numbers we've come up with. So that 20% reduction factors in some firms essentially retaining all their space and just reusing some of it, and others making bigger changes than 20%. So some ultimately might obviously might get rid of all of their space, but fundamentally, there'll be a complete range from 0 to 100, pretty much.
Okay, thank you, Kieran. Maybe one for Matt here. We've had a question about apartments. Obviously, this may be partly my fault for emphasizing apartments and the role in cities with the commercial supply likely to become more obsolete going forward. For what reasons would you think that apartments could fill the gap that's been left by office and retail space?
Well, for some of the reasons I laid out before, cities, are popular not just for proximity to work. People are drawn to them for many reasons. Cultural, entertainment, even a better marriage market. People have said young people go to cities because it's the best place to find a match if you're coming from your small regional town. And as we said earlier, working from home will increase, but a lot of those people will still be working part-time in the office. So while, that's going, proximity to work will still be valued. And if you can work part-time in a larger apartment and go to the office 2 days a week, you're still going to want to be in the middle of the city. So the reason it's in the winners column is because we think space will be converted from offices and retail towards apartment and living spaces. As I say, it's in terms of the investment outlook, it's maybe not that as rosy given the fact that capital values may take a hit. Rental growth will be constrained by affordability. But yeah, in terms of supply and where the investment will go, I think apartments are certainly up there.
Okay, thanks, Matt. I might feel when we've had a couple relating to social distancing, I would say, we may not have said this explicitly, but our general view on the social distancing side of things, that this will be a temporary phenomenon. Possibly a quarter or two is the horizon that we're thinking about before, given the effective vaccines, that we would expect social distancing measures to not be as a sort of permanent feature of the future. Obviously, this is the virus, and we don't know everything about how it might evolve over time. But that is our underlying assumption, and a lot of the forecasts that we've made over the very long term sort of kick in towards the end of this year in terms of the assumptions. Maybe I could ask Amy then a question about industrial property. Do you have any thoughts on the impact of COVID on supply chain dynamics going forward?
So there's definitely been a lot of discussion about the potential for firms to hold more inventory or reshore and nearshore post-COVID. But in our view, it won't be the virus alone that drives these types of changes in supply chains. There's a couple of reasons for this. On the one hand, there's a lot of cost and practical factors that need to be considered. The dominance of China and complexities of modern supply chains mean these types of things don't happen overnight. And in Europe, there's issues of capacity, which means that a big pullback in production also can't be done on a large scale necessarily. Along with that, what we have seen is that it wasn't actually until the 2019 significant shift in US trade policy that there was really a shift away from manufacturing in China. And even this was back to other low-cost Asian countries in Mexico rather than domestically. So that's not to say we're not going to see a shift in supply chains in the future, but we think it's more likely they'll be driven by other factors like technology or politics rather than the pandemic.
Okay, thanks, Amy. I think we'll take one more question, and maybe I'll go back to offices and Kieran, as that seems to be the majority of what people have asked. A point that someone's asked, a question that someone's asked here is, given our analysis, obviously we're talking about offices as a whole, have we got anything to say about how different types of offices or different office markets in town versus out of town, say, could perform over time?
Yes, so we do, and I think there's a few different kind of breakdowns you could look at to kind of consider the question. So, as you talked about in terms of cities, you can look at the biggest cities versus kind of the medium cities, so that there could be some change there. There's an element of the type of stock and where it's located within a central area, within a downtown area. So, for example, we talked about development reducing, but actually, if you're a developer developing some very nice, shiny new office building in the next 5 or 10 years, close to a transport hub where there's good retail and leisure offerings, then that will probably still actually perform quite well. It will attract tenants from other buildings and other sub-locations or sub-markets. And it's those that are poorly located and potentially older and lower quality stock that will be the stock that becomes obsolete and then gets converted to alternative uses. And then kind of the other, as you say, main consideration is about kind of in-town versus suburban office space, which is something we've written about recently. So this is essentially the so-called hub and spoke model. So, I mean, there's some logic in it. So obviously a firm could save money by reducing their CBD space and taking cheaper space out of town, providing space more local to workers. But for us, it doesn't really hold up that well. So, there might be some element of this, but in general, for most firms, it doesn't kind of tick the boxes that well for workers who still then have to commute somewhere, don't have the complete flexibility of being at home. And for firms, obviously, there's still a cost. It's still not completely, relatively free as employees working from home is. And then there's also, like, if you think about the commute, lots of cities are not really set up for people to commute from suburb to suburb, or necessarily from the centre to the or to certain suburbs. So ultimately, you could spend a similar or same amount of time commuting to somewhere that doesn't kind of have the same benefits as central areas anyway. And I think if you look at some of the surveys, the evidence kind of shows that even though this has kind of caught on a bit, even now, like around a third of firms are saying that they're even considering a hub and spoke model, and the numbers for those who are generally considering new strategies or and how they work and using more flexible space, those numbers are all like well above 50-60%. So it doesn't feel like it's something that's gonna catch on hugely, both because it's not something that's already happening hugely, and also for the reasons I laid out, that we don't think it really stacks up from a logical and cost-based perspective.
Okay, thanks, Kieran. We're just coming up to the 45 minutes, so I think that's probably all we're going to cover today. I'd like to say thanks for all the questions we have. I did as many as I could, and there's a lot more, including some very interesting ones, and we will respond to these over the next a few days. Before I wrap up, I'd like to say thanks to the presenters as well. and also remind you for the final time about the resources you can download on your screens. Please note also that a copy of the slides and a recording will be emailed to all attendees. All that remains is for me to say thanks to all of you for joining us and for you to enjoy the rest of the day.